Is this rebound just a dead cat bounce and we're heading lower, or are we going to break out and head back to all-time highs for another massive rally during the month of October? A very popular narrative right now is that we've topped, there was a 6-month rebound rally, and that we are heading much lower. We've begun the downtrend again. And actually from the low right here in March all the way to the top, it was around 160 days. And if we compare that to the Great Depression, this is the stock market during the Great Depression in 1929. You can see this was the initial drop, then it bottomed. The markets rebounded for around 6 months before heading back lower. And the argument here is that the Fed intervention that we have in 2020 has actually made the dead cat bounce much larger and more powerful than what it would have been without the Fed, just like in 1929. But before we discuss the bear market rally scenario, we're going to talk about our short-term positioning in the markets, how healthy we think that this rebound has been, and then we're going to compare this to previous bear market rallies in history. So without further ado, let's get right into it. So the stock market broke out of a wedge pattern. We were looking at this pattern for pretty much the entire correction, the entire last part of the correction. We were looking at this pattern. And last video, we discussed that this was a great buying opportunity on the break of this trend line right here. So far we've rallied from the break. It was a powerful breakout, and we've run into resistance at the 3,400 point level. So this is major resistance right here, okay? And it's pretty obvious. It was the previous all-time high in February. We had a consolidation at the all-time high right here in August. And during this correction, we broke down, back tested it, and rejected off of it for one more leg down. And so far, we are currently testing this level again. So if you bought on this breakout here, you should be raising your stop loss because we are at resistance. And you should definitely not be buying just under major resistance, okay? We do think that we are going to be breaking this level eventually, but we haven't ruled out the possibility of a final retest of this low before ultimately rallying. So the next buying opportunity would be a break above this level, the 3,400 point level, a break, a back test, and that's your opportunity to go long, not just under. Although it does seem like we are making a nice run up today, a nice green candle. We'll have to see how this develops. It could be the beginning of a nice breakout. But no matter how confident you are in your analysis, you have to know what your downside risk is. And we do have a lot of risk right now. The number of cases is starting to go back up. We're no longer in a downtrend. We are starting to get back into higher number of cases every day. There is huge uncertainty around the election. With the recent presidential debate, the possibility of a contested election, the president having just been tested positive, and also a stimulus package that is coming much, much later than initially anticipated. So that's your risk, okay? You have to know your risk. Even if you think the market forces are going to ultimately lead to a breakout, you have to know what your stop loss is and what the potential downside is to the market. There are 3 main rules that you need to understand in trading. Number 1, manage your risk. Number 2, manage your position sizing. And number 3, smash the like button to help our videos get boosted by the YouTube algorithm. All jokes aside, we do appreciate the massive support that we've been receiving from you guys. We do thank you so much for that. Now this brings us to the second part of this video, which is how healthy this rebound actually has been. And for that, we need to get onto a chart of the RSP. So it's also the S&P 500, but it's the equal weighted ETF. So why do we watch this? It's because it is a much more accurate representation of how the entire market is doing. A broad rally on the S&P 500 equal weighted is much healthier than just one sector pulling the entire market up. You want to see the S&P 500 equal weighted do well during rallies because it shows you how healthy it is. And so we made a community post on Saturday mentioning this bullish engulfing candle right here. That was very bullish on the RSP. This is the kind of thing that you want to see on a rebound. On a strong rebound, you see a bullish engulfing where the body engulfs multiple candles before. That's super bullish. Of course, this is not 100%, but it does indicate that the broad market is currently rallying, and it does seem to be doing so today as well. Now, it is starting to run into some resistance right here, so this is something to watch. What you want to see is the RSP pop above this level, backtest, and break out properly. Okay, this is a level that it's been struggling to get above. If this rebound takes us higher than this level, that's extremely bullish. That's another check mark for the bulls and would increase the likelihood of having another broad-based rally like we had during May and June. Now we're also going to look at the NASDAQ. The RSP is very important, but the NASDAQ has been pulling the markets up. So we have to look at the NASDAQ as well. It's the tech index. And so here we have a sharp correction with a major top here. And then we had a price channel going down right there with a resistance line and a support line right here. That channel broke out recently. The price broke out recently. And so far we have been heading back up. So the NASDAQ is looking bullish right now as well. Back here we had a bearish structure, and right now we're moving back into a more bullish structure. And we also made a community post and a Twitter post mentioning this level right here. That's a major level. If the NASDAQ stays above it and manages to hold this level, that's extremely bullish as well, and would increase the likelihood of more upside in the coming weeks. And in terms of the weekly chart, this remains one of the most important charts right now. It's telling us that we are heading for a blow off top. This was major resistance for the entire bull market. Tech broke out and it's currently backtesting successfully this line and heading higher. So that's extremely good news for the tech stocks right now. And when I say good news, I mean good news short to intermediate term. Obviously, this is not healthy price action. This is blow off top price action, and it will end badly. But in the meantime, lots of profits ahead as long as we remain above this line of resistance that's become support. And now the final part of the video, we're going to compare this rally right here to other bear market rallies in history using sentiment. And that's going to tell us whether it's likely or not that we topped on the 2nd of September right here. So to do that, we are going to be using Sentiment Trader. So if you want to check out their website, the link is in the description below. So this is the S&P 500, the black line right here. And this is the year 2000. It's the top of the dot-com bubble right here. And this blue line right here is the sentiment, the bearish sentiment using the AAII sentiment survey. So this is probably one of the most well-known sentiment surveys out there. And you can see we have the initial leg down on the S&P 500 right here. And there we have the first bear market rally right there. So we can see at the top of this bear market rally, the sentiment was at 28.6. That means only 28% of investors were bearish at the time. This is an extremely low number. And so you could say that the bear market rally did its job to shake out bearish interest, to raise bullish interest. And once everybody thinks the market is going up, well, that's when the market goes down. So that was how it played out during the year 2000 to 2002. We can now look at the financial crisis in 2008 right here. Same thing here. We have the initial leg down in 2008. And this was the first bear market rally right here. And you can see at the top of the bear market rally, bearish interest bottomed right here at 29.7. Again, that is extremely low. So the bear market rally did its job to shake out bearish interest before heading lower. Now let's go to 2020 right now, and you'll see that the top right here corresponds to around 40% bearish interest, which is absolutely massive. So again, this is just one of the reasons why we do not think that we've topped just yet. And we can also compare the same thing, not to the bear market rallies, but to the actual tops, and you'll see we have the exact same thing. Okay, the top of 2008 was record low bearish interest, and same thing in 2000 right here, record low bearish interest at the top of the dot-com bubble. The market tries to trap a maximum number of investors. So following that logic, in 2020, we have likely not topped just yet. So that's about all we wanted to cover in this video. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.